$15 trillion, gone, in one single trading session. Gold plunged 16%, silver crashed 40% intraday, the worst single-day move since the 1980s. Platinum, palladium, everything in precious metals, obliterated. And while every financial outlet on earth is blaming one man, one nomination, one moment in Washington, the real trigger happened days earlier, in China, in the dark, where millions of speculators woke up to find their entire gold investment wiped out. This wasn't a market correction. This was a detonation. And the worst part, the part that should terrify you, Monday hasn't happened yet. This is the story of what actually caused the crash, why the media has it completely wrong, and why the selling is about to get dramatically worse before it gets better. And if you hold gold, silver, or any precious metals right now, you need to understand every single piece of this before markets open. Let's start with what the media is telling you. They're saying the crash was triggered by President Trump's nomination of Kevin Walsh as the next Federal Reserve Chair. Walsh is a hawk. He wants to shrink the Fed's balance sheet. He wants tighter monetary policy. He wants credibility restored. And when the nomination dropped, speculative money and precious metals came rushing out. Investors had been piling into gold and silver for months because they believed the Federal Reserve was losing its independence, that inflation was permanent, that the dollar was dying. Walsh's nomination destroyed that narrative overnight, and the sell-off began. That's the story. That's what you're hearing on every financial channel, and it's wrong. Not completely wrong. Walsh was the excuse. The trigger was already set days before anyone in Washington did anything. The trigger was in China. To understand what happened in China, you need to understand the gold speculation machine that was running there for months before the crash. The People's Bank of China had been buying massive amounts of gold. Everyone knew this. What nobody knew was the scale of retail speculation happening alongside it. Hundreds of small and medium-sized investment platforms across China were using social media to lure retail investors into gold and silver trades. The pitch was simple. Gold is going up. It has been going up for months. Get in now and make money fast. And it worked. Speculative money flooded in. Returns dwarfed stocks. Returns dwarfed cryptocurrency. Everyone wanted in. Millions of ordinary Chinese citizens poured their savings into gold through these platforms, chasing the returns, believing prices would only go one direction. But here is where it gets dangerous. These platforms did not have proper hedging mechanisms. They were not built to handle a sharp decline. They were built to ride the wave up. And when prices started moving down even slightly, the platforms could not release funds. Investors tried to cash out. The money wasn't there. Panic spread. Word got around on social media. More investors rushed to withdraw. More platforms froze withdrawals. The losses multiplied. Lawyers specializing in investment disputes. So Friday was not the bottom. Friday was the beginning. Let me show you exactly why Monday is going to be worse. Three forces are about to hit simultaneously. Force 1, Chinese liquidation. Millions of speculators waking up to losses they haven't processed yet. Platforms that can't release funds. Panic that has already started spreading through Chinese social media. When those markets open, the rush to sell is going to be massive. This is not institutional selling. This is retail panic. And retail panic moves fast and moves hard. Force 2, margin requirements increasing. Gold, silver, platinum, and palladium futures margins are going up for both standard and heightened risk profiles. That means anyone trading futures in precious metals now needs to put up more collateral to maintain their positions, more cash. Right now, if you don't have it, you get liquidated automatically. No choice, no warning. The system forces you out. That change goes into effect after markets close Monday, which means between now and Monday close, traders have one window to either add cash or exit. The ones who can't add cash will be forced out, and forced selling means more downward pressure on prices. Force 3, the machines. This is where it gets really dangerous. Going into Friday, systematic traders, the algorithmic funds that control trillions in assets, were positioned heavily long. According to Morgan Stanley's data, quantitative funds were estimated to be net long $5 billion in silver. That's the 94th percentile versus the last 5 years. 94th. And they were net long $15 billion in gold. These machines don't think. They don't analyze fundamentals. They follow momentum and threshold levels. When prices break below certain levels, they sell, automatically, mechanically, no hesitation. Friday triggered those levels for some of them. Monday will trigger them for more. And as these machines close their long positions, some of them will flip to short, which means they won't just stop buying. They will actively bet against gold and silver, pushing prices lower, triggering more stops, more liquidations, more selling. It's a cascade. And it hasn't fully started yet. There is one more force that most people are completely ignoring: call options. Record amounts of call options have been purchased on gold and silver over the past several months. Goldman Sachs noted that this record wave of call option purchases had been mechanically reinforcing the upward price move. Here is how that works. When retail and institutional investors buy call options, which are contracts giving them the right to buy at a set price, dealers on the other side of that trade have to hedge their exposure. They do this by buying the underlying asset, gold, silver. So as more calls were purchased, dealers were forced to buy more gold and silver to hedge. This buying pressure pushed prices higher. It created a feedback loop. More calls bought, more dealer buying, higher prices, more calls bought. But now those options are expiring. And when they expire, the dealers no longer need to hold the underlying asset to hedge. So they sell it, dump it, all at once. This is not speculation about what might happen. This is a mechanical necessity built into the structure of the options market. When the calls expire, the dealers sell the gold and silver they bought to hedge. And given the record amount of calls that were purchased, the amount of gold and silver that needs to be sold is going to be enormous. So here is the full picture. Friday's crash was not the event. Friday's crash was the warning shot. The real liquidation has barely started. Chinese retail speculators haven't sold yet. Margin calls haven't hit yet. The systematic machines haven't fully unwound yet. The call option expiration selling hasn't happened yet. Each of these forces pushes prices lower. And each wave of lower prices triggers the next force. This is exactly how precious metals bubbles have ended throughout history. Parabolic move up, then the denial phase, where a sharp drop happens but buyers rush in believing it's a dip to buy, and then the real crash, the fear phase, where the denial buyers get destroyed and prices collapse far beyond what anyone thought was possible. Friday was the denial phase. Buyers stepped in late Friday. They bought the dip. They believe they got a bargain. They are setting themselves up to get crushed. Christopher Wong, a strategist overseeing Chinese banking research, put it perfectly. Parabolic moves are an escalator up and an elevator shaft down. That is exactly what is happening here. Gold and silver went up slowly, steadily, over months. The sell-off is happening in days, and it's not done. The cycle of a bubble always ends the same way. And we are in the early stages of the fear phase, not the late stages. The relief rally is coming. It might come Monday, it might come Tuesday. Buyers will step in again. They'll believe the worst is over, and then the next wave of selling hits. The machines, the margin calls, the option expirations, and prices go to levels nobody thought were possible. Jeffrey Gundlach, one of the most respected fixed income managers in the world, has been saying for weeks to hold 20% of your portfolio in cash, not because cash is a good investment. Because if precious metals follow the classic bubble cycle, and everything you've seen this weekend suggests they are, there is going to be an opportunity to buy gold and silver at prices you never thought you'd see again. The crash isn't the end. It's the setup for the greatest buying opportunity in precious metals in decades, but only if you have cash to deploy when the fear phase completes. If you're fully invested when it hits, you don't get to buy the bottom. You are the bottom. You're the one getting liquidated so someone else can buy cheap. Here's the timeline as it stands. Monday, Chinese markets open, retail panic selling begins, margin requirements increase after close, systematic machines continue unwinding longs, prices fall further. Tuesday through Friday, the denial rally. Buyers step in believing the worst is over. Prices bounce, relief spreads. The following week, the fear phase. Option expirations force dealer selling. Final wave of machine liquidation, margin calls on the denial buyers, prices collapse to levels that represent the true bottom, and after that, the recovery begins. But only after the bubble has fully deflated. Only after. This is not a normal market pullback. This is a structural unwind. $15 trillion wiped out in one day, and the forces that caused it are still in motion. The media has the wrong story. The real story started in China. It's being accelerated by machines, by margin requirements, and by the mechanics of the options market, and it is going to get significantly worse before it gets better. The question is not whether the selling continues. The question is whether you understand the mechanism well enough to protect yourself, and whether you're positioned to take advantage when the real bottom finally arrives, because it will arrive, and when it does, it will be the opportunity of a generation. But only if you survive the next 2 weeks.